Okay, David, we are now recording. How are you doing?
I'm doing well, Mark.
You're surviving winter in the outskirts of Chicago?
Yeah, looking forward to spring. It's chilly here today, but sunny, so I'm not complaining.
Yeah, we had some rain. It's now turning to ice, the typical March freeze thaw cycle. We're not here to talk about the weather as much as we'd like to. We're here to talk about February 2025 eGrocery sales numbers. And I'm going to ask you, as I always do, give me the headline.
Yeah, I'm not the best with headlines, but here I'll give it a shot. Seventh consecutive month over $9.5 billion.
We'll dig into it, but the record keeps going. Let me ask you, what surprised you about February's numbers? I can tell you what surprised me, but I'll ask you first.
Well, that the growth rate accelerated would be the short answer.
Growth rate in terms of repeat purchases or
No, in terms of sales, and
sales?
specifically with delivery. I mean, it's not surprising, but it's still shocking that we're seeing the cumulative effects of all of the aggressive promotion to lock in customers on their membership or subscription plans for a 12-month period. We're continuing to roll through that as additional waves, cohorts, or tranches get added to that. We're having this kind of cumulative effect stacking one on top of the other, and it's accelerated the sales growth even more than prior. But again, that's a reflection of the dynamics that are now at play. What surprised you, Mark?
I think not only the top line number, but I think the supermarkets and regional grocers also had a spike in terms of repeat customers, which is a bigger spike than possibly anticipated, which could lead you to assume or understand that they're making improvements in terms of the overall value convenience equation when it comes to online grocery.
Well, I think that definitely is one way to read the results. I mean, obviously, there's a lot that could be driving it. I think if you just kind of step back and say what's changed in the recent past, that would explain that. One would be that more customers are now ordering vis-a-vis a membership or subscription. So the intent to use that service again in the next month could also be affected by the reduced friction associated with that explicit cost, because now the person, when they're completing that order, especially for delivery, is not seeing that $7.99, $8.99, whatever delivery fee each and every time they're placing the order. So that could be also what's driving part of that beyond some of the experiential parts.
So you're saying it's not necessarily an uptick in the number of regionals who are offering membership. It's by membership program by proxy, as it were.
No. What I'm just saying is you were talking about the likelihood of repeat rate going up, and all I'm saying is that one other contributing factor that we have to account for is the use and presence of membership and subscription when placing that order, right? I mean, what we can see is looking at most recent purchase, Walmart's orders really over-indexed relative to that measure, meaning there's a much higher percentage of orders being placed with Walmart today that also have an associated membership with their program as compared to other formats. Now, that right there could be a factor that's pushing up repeat rates. Now, you were talking about grocery. Same thing could apply there. There are plenty of retailers who offer subscription or membership programs. And again, what we're seeing is an increased percentage of orders now being placed on those programs or with people who have those programs.
Any other mitigating or factors in February, like weather? Do you think people have a sense of upcoming changes to SNAP and there might be some pantry loading going on?
There could be pantry loading with SNAP. That would be dependent upon the awareness of those households of an impending change. So we don't know for a fact whether that happened or not. What we can see is that the lowest income group, those under 50,000, are still sticking with shopping online. And again, we haven't had a major change. Now, they could also have membership and subscription programs which lessen the financial impact each and every time they order. However, if we see another dramatic and sudden drop in SNAP purchase benefits, we could expect or should expect a pullback in that subgroup that's using online. We just haven't seen it. Concern about one's health is something that we used to track early in COVID, but what we had seen with that was the correlation between concern, the level of concern for contracting a respiratory virus, which could have included COVID or RSV or the flu, generally was most correlated with those who had extreme concerns. It broke down pretty quickly once you moved out of that level. So we don't know what that looks like today because we're not continuing to track that measure. But, obviously we are in a period where there is some respiratory contagion spreading, right? Think bird flu or measles now in Texas.
Mhm.
Those can all be contributing factors. Now, they may be on a more regionalized basis. However, we're not looking at those metrics at this point. But with that being said, I'm sure there's a group of highly concerned people who are in the most sensitive class, those people who have maybe immune compromised systems that would be motivated to change how they shop. But we just don't have the data to answer that.
Customer retention versus habit formation. Because in the numbers we can see that first time there was a spike in the number of first time repeat users and their sentiment was much higher. So what do you think is driving that?
Well, we didn't dig deep enough in to answer specifically that question, but again, the hypothesis is one thing that could be driving that higher repeat rate could be that some of those customers are coming in through a membership or subscription. Now, historically, we would have questioned whether that logic would hold up because typically those programs tend to attract existing customers who see immediately the benefit of subscribing. But what we've also seen more recently is that other people, like adult parents, have gifted these memberships to their parents. So we could, in fact, have first timers who are coming on board vis-a-vis a membership or subscription program. And that by itself could be a major trigger for the upswing that we saw this month. That's just a hypothesis, Mark, because we haven't really dug deeper into that. Beyond that would be, someone who's first timer on a new service may just be impressed with the experience. So if you think about someone who may be shopped with a regional grocer and now has tried someone like Walmart for the first time online, they may be pleasantly surprised by the experience that they had compared to what they knew before. So, those could be two explanations that could explain that uptick. But what we did see was a significant jump in the likelihood to reuse the most recent grocery service. And much of that was driven by the first timer. So it's something that we're going to continue to look into. It's a good sign, at least for those who are driving first timers to their service. And again, let me be clear, when we say first timers, we're simply saying those houses are using a specific service for the first time within the last 3 months. So they could, in fact, be lapsed customers returning. They could even be very infrequent customers, someone who's purchasing maybe less than once every quarter. So a lot there to dig into, but those are some of the initial thoughts we have on that.
Could you talk a little bit about the middle class and the results in February? We really didn't see any real online grocery growth in that income bracket. Is this due to some economic issue, or is that demographic basically stalled?
Well, that middle income group also tends to correlate closely with the two middle age groups, the 30 to 44, which is the primary household formation group, and then the 45 to 60. Those folks are dealing with a lot of other issues, right? Return to office. So if you're in the 30 to 44 and dealing with return to office, whether you're a single or double income household with kids, that is now triggering the incremental costs that you haven't had for a long time of commuting expenses, as well as potentially childcare services. So those groups in particular are probably feeling more pressure and that may be motivating where and how they shop online. Obviously, there could be other factors beyond that, but those would be the two immediate ones that we would look at as potential explanations for that.
And somewhat related to that demographic, that income group, and correct me if I'm wrong, but I think the number of households in the U.S. that are actually buying online, is that a record high? I think it's coming in at 80 million.
Yeah, we saw total monthly active users for the month grow over 10%. I think it was 12%, and it did finish at 80.3. That is the new high record. It surpasses the previous high that I think we set just a couple months ago. Again, if you were looking at some of the previous 6 to 7 months in the monthly report, you can see that we had a stair step up, essentially moving the base business incrementally north, and we've kind of stabilized at that new level. And so we're still cycling through that, which is why we're having such dramatic year-over-year growth. Again, keeping in mind that we started to really report this uptick in July of 2024. So we have at least through June of this year to cycle through or lap those comps. But again, the signs are, while it may slow up on lapping, we're still picking up accelerated growth, which would suggest still above longer term average growth rate in the second half of the year.
And I know there's a lot of variables that will affect that. Inflation, tariffs. It's a little early, I guess, to give me an indication as to where you see things growing or stalling. Do you have a sense later this year as to what the market growth rate's going to be overall?
Online, conservatively, we're going to be, stronger than what we had planned for last year. We had exceeded our plan or our projection last year by a good 4 percentage points. So, at this point, it looks like online could be on pace to have potentially around a plus 10% growth rate for 2025. That's obviously based on what we know now and making, certain assumptions about what's going to change. The challenge that every business is going to have today is there is a huge amount of uncertainty out there driven by the policies coming out of the current administration. They can be quite dramatic and disruptive. We just don't know what we don't know. We're going to have to wait and see and assume that those policies are not intended to hurt the American, household or the American economy. That remains to be seen because many of these things are regressive in nature and will have a negative impact on growth going forward. It's just too early to tell, unfortunately.
Yeah. You were going to ask me a question, David?
Yeah, I was just curious from your standpoint. One of the things that we're seeing is when someone orders from, let's say, Walmart, the vast majority, we're talking over 80%, could be close to 90% of all orders are being filled through the Walmart app or website. When we look at supermarkets or regional grocers, that number, comparatively speaking, is probably closer to 50%, meaning only half of the customers who are ordering from a regional grocer are doing so directly with the retailer through the first party. And I guess the question from that observation is, what are you seeing regionals do in regards to trying to nudge more demand to first party or to build the first party business and look at third party as a potential resource for doing so?
I think this trend started a couple of years ago. We've talked about using differential pricing to drive third party customers to first party platforms. I don't see that trend going away. Not every retailer is doing it, depending if they're an everyday low price retailer. That can be somewhat challenging. From a customer perception perspective, we're also seeing retailers focus on doing top above the line marketing, encouraging customers to utilize their business online through different service levels and the ability to focus on quality of produce, quality of goods that are coming from that retailer. it's really a strong effort to commoditize what those third parties are doing. As I said before, really focusing on diversification of delivery, and then imbuing their loyalty programs, their personalization promotion programs, so customers are incentivized to purchase via first-party channel.
I think it's important to remember that if all things being equal, meaning the customer doesn't pay anything more compared to shopping in store, online is going to win. Now, Walmart is very close to that. At this point, if you're ordering from Walmart, especially with a membership, the only incremental cost you really have on a per order basis is the gratuity. And again, that's optional. So today, someone who's a member, and again, keep in mind, there may be households who are members of Walmart Plus who were gifted that by their adult children, for instance. So they have all the incentive in the world to shift their purchases that way. I think it's Walmart's game to lose. Their challenge is winning over the fresh component of the basket from their non-primary shoppers, which is going to be very difficult. And, for Walmart, they're going to continue to have very challenging times competing against Amazon in ship to home segment. So while Walmart is on a roll with pickup and delivery, they're still fighting a very challenging adversary in the ship to home segment, and they are a distant second. Let's keep that in mind. So it's not all roses for Walmart. And again, Walmart's draw right now is delivery because they've disintermediated the issues that were preventing them from capturing additional customers who were, reluctant to shop with them for various reasons.
Well, that's it, David. I think that's all we have for this month. David, it's been great talking to you as always. So I appreciate your time this month, and we look forward to another report, another interview next month.
I appreciate it, Mark. Look forward to chatting next month.
Now, how do people get in touch with you? Just remind them.
They can send me an email at david.bishop@brickmeetsclick.com or send me a message or connect on LinkedIn.
Perfect. Take care, my friend. We'll see you next time.
All right, man. Have a good one.